You're all very welcome to Chartered Accountants Ulster Society's latest webinar on the VAT changes that the UK's departure from the EU has brought about. My name is Crowley. I'm the Public Policy Lead and Brexit spokesperson for the Institute. So I'm delighted to see so many of you here today. I think it's definitely reflective of the requirement for knowledge in this area. So you're all very welcome. I'm delighted to join, welcome the policy advisors from the HMRC VAT team. We have a number of them here today on the webinar. Just to get a little bit of housekeeping out of the way before I introduce our speakers today, the presentation will take about 35 to 40 minutes, and it'll be followed by a Q&A session for about 20 minutes. So if you do have a question during the presentation, please do use the Q&A function at the bottom of your screen, and we will try to get to as many questions as we can before the hour is up, because we do promise to finish promptly at 3 p.m. If you could use the Q&A function as opposed to the chat function, we'd be very, very grateful, because we can monitor and get to all your questions through the Q&A. The slides will be available for participants at the end of the webinar. We're also recording the session, so that recording will be made available as soon as it's ready. We also have a number of poll questions, which I'll introduce at the end of the presentation, which we'd love to get your feedback on. So before we get started, I'd like to just briefly give you an outline of what the webinar will entail today. We've got three main speakers from HMRC, and I know there's a couple of other colleagues that are represented to help with the Q&A. We have, first up, we'll have Heather Elliott, and she's going to give a brief overview of the new rules and then really focus in on postponed VAT accounting and the practical implications of using that method of accounting. She's then going to hand over to Will Pereira, who's going to talk about the VAT on consignments of £135 or less. And then finally, Philip Crowley is going to talk about the new rules that have fallen under the Northern Ireland Protocol. And he's included a number of practical examples in the slides to go through. There'll also be links then to HMRC's guidance in this area, and then a Q&A session will then follow. So you're all very welcome. I hope you enjoy the session. Don't be afraid to ask any questions. We'll try to get to as many as we can. And for now, I'll hand over to Heather. So thank you, Heather.
Well, hello, everybody, and thank you for that introduction. And I hope you can see me, just adjusting my camera a little bit there so I fit into the screen. It's good to be with you today. I'm not sure whether it's better or worse to be doing this online or doing it face-to-face like we have done previously. So, exports and dispatches, just a quick overview of this, because I'm sure most of you will know the context that we're working in now since the 1st of January. So, movements of goods from Great Britain to the EU or exports, and from Northern Ireland to the EU, they continue to be dispatches as they were previously. Now, for goods moved from Northern Ireland to the EU, then the previous inter-community rules remain, and business to business, B2B supplies, are zero rated as dispatches. And for Northern Ireland to EU business to consumer supplies, B2C, of excise goods, they require the seller to register for VAT in the place of consumption, and there's no threshold for that. And the movement of goods is deemed a supply of the transfer of own goods. Now, for exports from GB to the EU, goods are zero rated whether or not they're excise. So on to the next slide, please. So for imports and acquisitions, again, from the 1st of January this year, movements of goods from the EU to GB are imports. They're no longer acquisitions, and import VAT, and it's not acquisition VAT anymore, is due. Acquisition VAT continues to be due on goods moved from the EU into Northern Ireland. Now, postponed VAT accounting, which I'm going to talk about in a bit more detail in a moment, is available to UK VAT registered businesses who import goods into Great Britain from anywhere outside the UK, or import goods into Northern Ireland from outside the UK and the EU. And this allows importers to account for and recover import VAT on the same VAT return, and it is available permanently. And I point that out because some people think it's connected to the current temporary rules at the moment. It's not. It will continue to be available Other existing means of VAT are also available, so what people have been used to doing, that's still available. And non-VAT registered traders, they have to pay import VAT when they make their customs declarations. And there are different rules that apply to goods, apart from excise, in consignments of £135 or less. And we'll hear more about that later. Okay, so postponed VAT accounting. Now this is, to start the process, you have to select it on your customs declaration, and you enter the trader's URI number if you're using Chief, or if you're using CDS, then you use the VAT registration number. And what happens after the customs entry is done is an online monthly statement is generated, and the trader can access that and download it, and that's the information that they will need to complete their VAT return. Now, you don't need to be authorised to use postponed VAT accounting, but you have to go through the process of getting access to CDS in order to see those monthly online postponed VAT accounting statements. If you're going to use PVA, then the goods must be for use in the business. Now, non-established taxable persons can use PVA to bring goods into to the UK, but they must hold a UK URI, and they will need to get an agent to make those declarations on their behalf. They can use it, but somebody will need to do that for them. Now, I should say that all the information that I'm sharing with you here is available in the guidance, and when you get the slides, you'll see the links to the various guidance pages in these slides. So don't worry about finding all this again. So postponed VAT accounting is available when the imported goods are removed into free circulation from a customs special procedure as well. It can be used when imported excise goods are released for home consumption. And this includes when the goods are released from an excise warehouse after being in duty suspense since the point of import. Now, in most cases, PVA is normally optional. However, if you're importing non-controlled goods into Great Britain from the EU between the 1st of January this year and the end of the year, then you must use PVA in a couple of circumstances, and that's where you delay your customs declaration, or if you're using simplified customs declarations, if you're authorised to do that and you're making declarations in your own records. So that's when you must use it, if you're delaying or recording in your own records. Now, using somebody to import goods on your behalf, you probably know that we recommend that you do this because it can be quite complicated and technical. So if you're getting somebody to do this for you, so it might be a freight forwarder, customs agent, a broker, a fast parcel operator, you as the importer need to tell them what you want to do in terms of the import VAT so that they can complete the customs declaration for you. It's very important that you have that conversation and that you keep that in writing as well. So if you've already got a relationship with somebody, tell them that's what you want to do. If you're a new importer, getting somebody to do that for you, again, you need to tell them. Agree that in writing, and be aware that once that declaration has been made and you've selected postponed VAT accounting, or conversely, you've chosen not to use postponed VAT accounting, then we can't change that after the event. So you have to make sure that that's right first time. Okay, moving on. So business versus non-business import. So if you are able to use postponed VAT accounting on your return if you import goods which are used for both business and non-business purposes, or if you're not sure at the point of import whether they will be used for business purposes at that point. But you can't use it if you know at the point when the goods are imported that they are solely for a non-business purpose. So you can't select PVA on your customs declaration and you'll have to make immediate payment for the VAT or use your duty deferment account. I should say here, I keep talking to you as if I'm addressing importers. I know lots of you won't be importers, you'll perhaps be acting on behalf of importers, but I'm addressing as if I'm talking to importers here. So, on to completing the VAT return. Again, this is something that needs to be done as part of the process, and there are changes to some of the boxes, or the way that the boxes will be completed on the VAT return. Again, all of this is in guidance, so you can check it out later. Box 1, so that needs to include the VAT due on the PVA imports. box 4 is the VAT reclaimed, and the normal rules about reclaiming VAT apply to the import VAT that you can reclaim. And then box 7 is, it should include the total net value of the imports. And as I say, the normal rules will apply in terms of what you're allowed to reclaim. And the monthly statements that I mentioned previously, they contain the information that's needed to complete those boxes. Now, if the importer has delayed their declaration, then they won't have the statement at the point when they need to complete their VAT return. In that case, they'll need to make an estimate of the import VAT due on their VAT return. So that's for anybody who's doing those delayed declarations. And then once they submit the supplementary declaration, then they should say at that point that they're using postponed VAT accounting, and then in the following month the statement will be generated and it will show the amount of import VAT due on that declaration, and then the importer will be able to go back, have a look at the VAT return, see what they've estimated there, look in their VAT records, see what's on the statement, and if needs be, then they can make an adjustment between the two of those. And again, the guidance tells you more about that. So let's see what we've got on the next slide. Okay, so this is how to access the statements. So all importers who are going to use postponed VAT accounting need to access CDS, as I said earlier, and that applies to Chief users as well. So if you're using Chief to make your import declarations, you still need to access this service to see those statements and to download them. And at this point, I'll mention that they're available online for 6 months. So the importer will need to download them within 6 months. They'll need to see them sooner than that in order to complete their VAT return, but they need to download them and keep them in their own records before the 6 months is up. So in terms of how you do this, as I mentioned, all this is in our guidance. And on one of the pages, it's headed Getting Your Statements. The importer will go to that page and start there. There's a big green button, click on that, and if they're already if they already have access to CDS, that will take them straight through to the financial dashboard part of CDS where they can see those statements. If they don't already have access, then it will take them through an access journey where they'll need to sign up, they'll need to give us some information, their URI number, UTR, various other bits and pieces of information in order to give them access to that service. And then where we're up to now, the statements that are available now are for January, February and March. I'll just say at this point that we did have some difficulties with the January and the February statements, and so those have been reproduced correctly in March. So importers might go on to their dashboard and find that they've got more than one statement for January. They should use the ones that were produced in March, and again, we've got guidance on this. It's all clear, laid out in the guidance, what you should do with those. And each month, usually around the 6th of the month, the next month's statements will be produced. In terms of VAT group members, so everybody who is in a VAT group who is importing goods will have their own URI, and they will need to separately access CDS to see their statements. So that's slightly different from anyone who's familiar with the C79 certificates, where they were automatically sent to the representative member of the group. This is different for the VAT statements. So each member of the group will need to send their statements to the rep member who completes the VAT return on their behalf. So they'll collate all the information for the VAT return. I think that's enough on that one. So that was a very quick rush through all of that information on PVA, and we'll pick up questions later on, but I'm going to hand over to Will now, who will take you through the next part of the presentation.
Yeah, thanks Heather, and hello to everyone that's joined today. My name is, sorry, I'm just trying to check if my video is working.
I can see you, Will.
Okay, cool. Yeah, my name is Will Pereira, and I work in the VAT policy team for low value overseas goods. I'm at HMRC, and today I'll be talking through consignments valued at £135 or less. So the UK has introduced a new model for the VAT treatment of overseas goods, and that's to improve both the efficiency and compliance of businesses accounting for VAT. Just to say that the new model applies to goods imported into Great Britain from overseas and goods imported into Northern Ireland from outside the EU. So one of the main changes here is that VAT collection on consignments of goods valued at £135 or less has been shifted away from the border, and businesses liable for the VAT now have to register and account for the VAT on their UK VAT return. So from the end of the transition period, for goods located outside the UK at the point of sale and sold to customers in the UK in Great Britain, those customers will have UK VAT charged at the point of sale. And for goods located outside the UK and EU at the point of sale and sold to customers in Northern Ireland, for those customers, they'll have import VAT charged. And for both cases, it's the location of the goods at the point of sale that matters rather than the location of the seller. We've also made online marketplaces responsible for collecting VAT in certain circumstances. So where an online marketplace is involved in facilitating the sale, it will be responsible for charging, collecting, and accounting for the VAT instead of the seller. For goods sold by direct sellers, so without any marketplace involvement, the seller will be required to register and account for the VAT. On the £135 limit, it's important to note that the limit applies to the total value of the consignment rather than the separate value of individual items within a consignment. And on the last point, low value consignment relief, also known as LVCR, this was an import VAT relief for consignments valued at £15 or less. So this has been removed following the end of the transition period. So what this means is that VAT is now due on all goods supplied from overseas, regardless of value. If we could have the next slide, please. Thank you. So what does this mean? So for business to consumer supplies, or B2C, this is where the customer is not registered for VAT in the UK, or it also includes where a VAT registered customer does not provide its VAT registration number to the seller or online marketplace. That would also be treated as B2C. So here, the seller or the online marketplace where it facilitates the supply will be required to register and account for VAT on their VAT return. And if the seller or online marketplace is already registered for VAT in the UK, then they won't need to register again. And for business to business supplies, or B2B, so this is where a UK VAT registered customer provides its VAT registration number to the seller or the online marketplace. And here it's the VAT registered business customer that's responsible for accounting for the VAT due on their VAT return. For goods imported into Great Britain, this can be done through a reverse charge procedure. And for goods imported into Northern Ireland, this can be done through postponed VAT accounting. And in both of those cases for B2B, the business will be able to recover the VAT as input tax on the same VAT return subject to the normal recovery rules. The last point here is that there are some exceptions to the normal rules. So the rules do not apply to consignments containing excise goods or to non-commercial transactions between private individuals, such as gifts, for example. For these goods, the rules for consignments of goods valued above £135 or £135 will apply, with import VAT typically collected at the border. So that's a quick run through low value imports. I'll now hand over to my colleague Phil to cover VAT under the Northern Ireland Protocol. Thank you.
Thanks, Will. Good afternoon, everyone. Thank you for joining. I'll be talking through VAT under the Northern Ireland Protocol in this part of the presentation. My name is Philip Crowley and I work in the policy and delivery of VAT under the Northern Ireland Protocol. So kicking off with movements between Great Britain and Northern Ireland. For most transactions where goods are sold between Great Britain and Northern Ireland, the seller of the goods should continue to charge their customers VAT and account for it on their VAT return. However, it is now import VAT and subject to import VAT rules, which include rules about valuation. This means that VAT is calculated on the customs value of the good, which includes incidental expenses such as transport and insurance costs, as well as any customs or excise duties that are due on the import. Import VAT does not need to be paid at the point of arrival into GB or Northern Ireland, as it will be accounted for via the VAT return instead in most cases. If the customer is VAT registered, they can reclaim input VAT subject to normal rules. Now, this would be where the goods are used by the business customer to make a taxable supply. There is a new requirement where a business moves its own goods from Great Britain to Northern Ireland. Import VAT is due in these cases. The business can reclaim that VAT as import tax subject to the normal rules. There should be no tax effect for taxable businesses, as they should in theory claim input VAT in box 4 on the same VAT return. They account for the output tax in box 1. And an import VAT charge does not arise where a business moves its own goods from Northern Ireland to Great Britain unless this is done as part of a sale or supply of the goods. There are some exceptions to that where the seller liability does not apply. The examples are goods subject to domestic reverse charge rules. In this case, the customer should continue to account for VAT via the VAT return and reclaim input VAT subject to normal rules. Excuse me. Also, goods declared into a special customs procedure, where this is used, the customer or importer will have to account for the VAT when the goods exit the procedure. Additionally, goods subject to an onward supply procedure. Now, this is available where the goods move from Great Britain to Northern Ireland and are consigned to be moved onto a final destination in an EU member state within 1 month. In this case, the final customer in the EU is required to account for the VAT as acquisition VAT. The importer will have to zero rate the goods, but would need to include that onward supply on an EC sales list. And finally, goods sold by a non-UK seller through an online marketplace, as has already been touched on. In this case, the online marketplace is liable to account for the VAT. So moving on to VAT groups. VAT groups can continue to include members established in Northern Ireland, as well as members established in Great Britain. So there is no requirement to restructure a VAT group with members in both Great Britain and Northern Ireland. And additionally, broadly speaking, transactions between UK VAT group members will continue as before, and in most cases can be disregarded for VAT purposes. There are a small number of exceptions, and these are supplied between group members where the goods move from Great Britain to Northern Ireland. In this case, they should be accounted for in the same way as a movement of own goods, as has been explained earlier. That would be an output VAT and an input VAT entry on a VAT return. And also supplies of goods in Northern Ireland between members where at least one member is not established in Northern Ireland. In this case, the representative member will have to account for the VAT on this transaction, and they can reclaim the input VAT subject to normal rules. Now looking at individuals and non-VAT registered businesses. Goods moved or sent from Great Britain to Northern Ireland by unregistered businesses or individuals will also incur import VAT, though in most cases the liability will be reduced to zero. This is because a legal credit is applied, which is valued at the amount of VAT that has previously been paid on the goods in Great Britain. As it is rare for the value to have increased between buying an item in Great Britain and sending it to Northern Ireland, the credit should cover, in most cases, any import VAT liability that would be due. However, where goods have not already had VAT charged on purchase, or if the value of the goods has significantly increased, the credit won't cover the full liability, and import VAT will be due. Individuals and non-VAT registered businesses carrying goods will need to use the relevant app to pay the import VAT, and individuals and non-VAT registered businesses sending goods will need to use a different solution, which HMRC will roll out later this year. Goods moved or sent from Northern Ireland to Great Britain by individuals and non-VAT registered businesses do not incur import VAT unless they're subject to a VAT res claim. The VAT res scheme is still available in Northern Ireland, allowing visitors from outside the EU to recover the VAT on purchases they make and then take home in their luggage. It is technically available for Northern Ireland retailers to visitors from Great Britain, although the retailer must collect the GB import VAT due on behalf of the customer and account for it on their VAT return. The retailer can only refund the supply VAT to the customer once the VAT 407 form has been returned to them, stamped by a customs officer when the customer leaves Northern Ireland or the EU, for example, if they return home via Dublin. However, the VAT refund given and the import VAT charged by the seller should be the same amount and net off to zero. For this reason, retailers may decide not to offer VAT res to visitors from Great Britain. Now moving on to goods moved between Northern Ireland and EU member states. As has been touched on previously, in line with the Northern Ireland Protocol, supplies of goods from Northern Ireland to the EU and from the EU to Northern Ireland will continue to follow intra-EU rules for VAT. So in terms of the VAT process, this remains pretty much as it was prior to the end of the transition period. When talking about supplies from Northern Ireland to the EU and vice versa, we focus on where the goods started and where it ended, rather than where the businesses are established. For example, a business established in London sending a good from its warehouse in Belfast to a customer in Dublin will be making a supply from Northern Ireland to an EU member state, so this is an intra-EU supply. The supply of services is not covered by the Northern Ireland Protocol. However, the rules for the place of the supply of services are broadly unchanged. Some exceptions are covered in the slide, and there's guidance on gov.uk covering these in more detail. For business to consumer sales, where the customer is not VAT registered, distance selling rules continue to apply. For sales from an EU member state to Northern Ireland, if an EU business makes more than £70,000 worth of sales to Northern Ireland customers annually, they will have exceeded the Northern Ireland distance selling threshold. This means that they should register and account for UK VAT on their NI distance selling threshold, on their NI distance sales. For sales from Northern Ireland to EU member states, each EU member state obviously will have its own annual distance selling threshold, so NI businesses will have to take account of these when selling to EU customers. So, for example, if they exceed their distance selling threshold in France, they would need to register for French VAT. So they just need to make sure that they're aware of each member state's threshold where they are making sales to customers there. For business-to-business sales, the customer should account for acquisition VAT. The recipient may account for any output tax on their VAT return and may also treat this as input tax on the same VAT return, subject to normal rules. Where a Northern Ireland seller sends goods to a VAT registered customer in the EU, the Northern Ireland seller should zero rate the goods. The seller should continue to submit an EC sales list, accurately accounting for the supply of such goods. However, as supplies of services are not covered by the NI protocol, these do not need to be included in an EC sales list. There's a new requirement for businesses carrying out transactions with the EU to use the XI prefix when communicating with EU systems or EU businesses, for example, on invoices. This requirement applies to businesses who receive goods in Northern Ireland from VAT registered EU businesses for business purposes, who sell or remove goods from Northern Ireland to an EU member state, or sell goods that are located in Northern Ireland at the time of supply. Now, HMRC identified certain businesses that require the XI prefix, and those businesses were contacted before the end of the transition period. However, businesses can still notify HMRC to request the ability to use the prefix through submitting a G form on gov.uk if they weren't automatically allocated it in the earlier exercise. Businesses that have an XI prefix will continue to appear on VIS on the web, so that EU businesses can continue to check their VAT status and verify that they are trading under the NI protocol. This will enable EU sellers to correctly account for their sale on businesses trading under the protocol. Moving on to EU VAT refunds. The VAT refund system is available to businesses who have an establishment in Northern Ireland and who make supplies in or from Northern Ireland or EU intra-community acquisitions. Businesses who meet those conditions can continue to use the electronic EU VAT refund system for VAT incurred in an EU member state for invoices that cover goods only. If a business doesn't meet these conditions, or the VAT invoice covers a transaction in services, the EU 13th directive process must be used. Under this process, a claim must be sent to the authorities in the EU country where the VAT was incurred, And there's further information about this on the EU Commission's website. So I'll now talk through situations sort of where goods move between two places via a third place. So the first example I'll talk through is where goods are sold from Great Britain to the EU via Northern Ireland. The VAT treatment depends on where the goods are, where the transfer of the rights to the goods takes place. So if the goods are located in Great Britain at the time of supply, the seller should charge the customer VAT and account for it on its VAT return. Only the EU customer can recover the VAT, either using the EU VAT refund system or a UK VAT return if they're registered for VAT in the UK. If an onward supply procedure is used, import VAT will be due in the EU member state of destination and accounted for there as acquisition VAT. Additionally, if a customs special procedure is used, like transit, import VAT is due where the goods exit the procedure. The onus will be on the importer to tell the seller where they have used one of these procedures and provide the required references so that the seller can zero rate the export. So here's a visual example of that journey. Samir's London-based business sells goods to a customer in Dublin, and the goods are transported from London to Dublin via Belfast. So to begin with, the goods are sold while they are being kept at Samir's premises in Great Britain and sold to the Republic of Ireland customer. In this case, Samir should charge UK VAT to the customer, which will be import VAT, accounted for via his UK VAT return in the same way as output VAT. The goods then make the crossing to Northern Ireland. No additional import VAT is payable as part of the customs process. And after this, the good can move freely from Northern Ireland into the Republic of Ireland. The goods arrive at the customer's address in Dublin. The customer can recover the VAT paid using the EU VAT refund system, or if they're UK VAT registered, the UK VAT return. So similarly, if the goods are moved to Northern Ireland and then are supplied, then two separate movements need to be accounted for. The first is a movement of goods, of own goods from Great Britain to Northern Ireland by the seller. As explained previously, this consists of output VAT and import VAT entries on the VAT return. This is then followed by an intra-community sale, which will either be an acquisition and dispatch or a distance sale where the customer is not VAT registered. So here's an example of this journey. Charlie's London-based business moves goods to Northern Ireland in preparation for selling to customers. Charlie then makes a sale from Belfast to a customer in Dublin. So to begin with, the goods begin in Charlie's depot in Great Britain. They're then moved from there to a depot in Belfast. The goods make the crossing from Great Britain to Northern Ireland. Charlie must account for this as a movement of own goods to Northern Ireland, accounting for import VAT as if it were output VAT and reclaiming import VAT subject to normal rules. The goods are moved to Charlie's Belfast depot. Then once they are there, they are supplied to a customer in Dublin. This is accounted for as an intra-EU sale. The goods are freely transported to the Republic of Ireland and arrive at the customer's address in Dublin. The VAT is reclaimed via the customer's VAT return if they're VAT registered. So now I'll talk through the reverse journey, where goods are sold from an EU member state to Great Britain and go via Northern Ireland on their journey. The EU business should charge the customer UK VAT and will have to register, if they aren't already, and account for the VAT on their VAT return. The UK customer will be able to reclaim the VAT as input tax subject to the normal rules. So here's a visual example of that one. So Abdul's Dublin-based business sells goods to a customer in London. The goods are transported from Dublin to London via Northern Ireland. So the goods begin in the Republic of Ireland and they are sold to a GB customer while they're there. As the goods are going via Northern Ireland to a customer in Great Britain, he will need to be VAT registered in the UK and should collect UK import VAT at the point of sale and account for it via the UK VAT return. The goods are freely transported to Northern Ireland and make the crossing to Great Britain. When they arrive in Great Britain, no additional import VAT is payable as part of the customs process. The goods are then driven to the customer's address in Great Britain. The customer is then able to recover this as import VAT via their UK VAT return, subject to normal rules. So that concludes that part of the presentation. Here are some links to some of the key guidance pages that touch upon what myself and my colleagues have talked through today. So here are the relevant pages for postponed VAT accounting, as well as how to get your monthly statement for postponed VAT accounting, and pages on how imports into the UK should be treated. On the next slide, I think there's further guidance on imports from the rest of the world and other areas here. And on the next slide are the relevant links covering VAT under the Northern Ireland Protocol. This includes movements from Great Britain to Northern Ireland, imports into Northern Ireland from elsewhere, and requirements related to the XI indicator for moving goods between Northern Ireland and EU member states. So that concludes this part of the presentation. I'll now hand back to Crona to take us to the next bit of the webinar. Thank you.
Thank you, Philip, and thank you, Heather and Will, for your input into the presentation. So just before we get to the Q&A, I see we have a number of questions coming in there. We might just put a poll on your screen if you wouldn't mind answering if there are 4 questions. So you may need to scroll down just to answer them. So I might just give a couple of moments just for everyone to answer the questions. Thank you in advance. Okay, I think hopefully everyone had a chance to answer all those. So thank you for your contribution. So I might just move to the questions. So the first question that we have there, I think this might be one for Helen. Sorry, Heather. Can a supply be deemed a business-to-business supply if the recipient of the supply is a business but is not VAT registered? Can the reverse charge rule apply in this scenario? I don't know if any of our panel would like to take that one.
Yeah, I think one of my colleagues might have something for that. If not, we will take it away with us.
Just to say, if it's in relation to consignments of goods valued up to £135, then the answer is no. The customer has to be registered for VAT for the B2B treatment to apply in those circumstances.
Okay, does any of our panel want to add anything to Will's answer?
I can confirm that the same answer is correct for people wishing to use postponed VAT accounting. That too doesn't have a reverse charge procedure. The customer should be accounting for VAT on their VAT return using their VAT registration number. Okay,
so I assume we're just talking about goods in this instance, not services.
Yes. Yeah. No, purely goods.
Okay, perfect. Thank you. So this was a clarification point, and it's just in relation to the point you made on the EC sales list. So when the purchase will be recorded on the VAT return in normal purchases and not need to be reported on the EC sales list. So I think this question came in for you, Philip. Sorry, I just couldn't see the screen there. So I'm just not sure the context of the exact question, actually, now that I read it. I assume maybe it would be helpful just to go through when there's instances that sales do need to be reported on an EC sales list when you're involving NI, because obviously they're still following the EU rules for goods. So Philip, do you want to take that one?
Yeah, happy to. So generally speaking, goods will be reported on. Goods will need to be reported on the EC sales list, sales of goods, but not sales of services. So that's when a good is sold by a business that is recognised as operating under the Northern Ireland Protocol and is registered with HMRC as such and has an XI prefix to add before their UK VAT number.
Okay, thank you. So I'm just going to continue just on the theme of goods. So actually just adding on to that EC list, can you advise if triangulation is still available for movements, I suppose, including NI and GB? So I assume it is available when NI is involved, but not when goods are moved in Great Britain. So this is the simplification procedure triangulation. Does any of the panel want to take that?
Yeah, I'm happy to take it. So triangulation isn't available where goods move to or from Great Britain, but where a UK business acts as the intermediary company and they are recognised as operating under the Northern Ireland Protocol and have a I'll start my video, and they have an XI prefix, having sort of registered with HMRC as operating under the Northern Ireland Protocol, they can continue to act as an intermediary company. But other than that, triangulation is not available for sort of GB businesses, but is available for a GB business operating in that capacity, if that makes sense.
Yeah, no, I think that answers the question. Just another one there, Philip, what we have you on the screen. If a seller moves goods from London to Dublin, so this was your example of GB to EU via NI. So if a seller moves goods from London to Dublin via NI, is it correct to say that that business charges UK VAT and there's no Irish import VAT?
So in principle, yes, because the goods are entering under the protocol, as Northern Ireland has the status of being within the EU VAT territory. If the goods enter the VAT territory at the point in Northern Ireland, then it will be UK import VAT due at that point, if that makes sense. So if you think about an example where a good were to enter one country, you would have import VAT charge at that point, even if they were to be then moved to an onward country. So because it's entering in Northern Ireland, it's UK import VAT rather than Irish VAT, if that makes sense.
Okay. And then what happens, so Philip, again, one for you, what happens if there is a supply of goods from EU and it travels through GB to NI? So it's kind of the reverse of what we were just talking about. So it starts in EU, goes, say, through London and then on to Belfast. So what's the VAT? If you could just maybe take us through a practical example of that, of how the VAT would work.
Yeah, sure. I'll certainly try to. So under the EU VAT rules, you look at where the goods started its journey and where it finishes its journey. So if it's moving from EU to Northern Ireland, in the starting position is that is an intra-EU supply, and so it should be an acquisition and dispatch or a distance sale, depending on the registration status of the recipient. Now, because it goes through GB, it will be subject to sort of import processes when it arrives in GB, which means that in those circumstances, there's a chance that it will incur import VAT in GB separate to that intra-EU supply if a procedure such as transit isn't used. So if transit is used, then it will be treated as effect. It will ignore GB for the purposes of VAT, and it will be treated purely as an intra-EU supply. But if it is sent without a sort of a customs suspended procedure, then the intra-EU sale will still apply, but there might be a further import VAT charge upon arrival in Great Britain, if that makes sense.
Okay, so it's complicated to say the least. Okay. So in terms of so this could be for anyone actually on the panel. It's just moving away from the examples that we've been covering. It's about the margin scheme on cars. I know there's been a lot of discussion on this, and I know the UK has applied for a derogation from the EU in terms of the application of the second-hand margin scheme on cars specifically. So my understanding is that there's been no update in terms of that request, but the guidance from HMRC was that from 1 January the derogation technically would apply. So what happens if the derogation isn't received from the EU, and what approach will HMRC take?
Thank you. Well, the government remains confident that we have a strong case for reaching an agreement with the European Commission on this issue, and we are continuing our dialogue with them in this regard, so it remains very much a live case. Whether any VAT would need to be recovered if a derogation cannot be agreed is a very complex issue. So HMRC would explore all options are available to us to fully mitigate any impact on businesses as a result following our guidance. So watch this space, I suppose, is the best answer for this. Thank you.
Okay, thank you, Martin. Question, if I sell goods to a customer in England and these move first through Northern Ireland, is it correct that I must register for VAT in the UK and charge UK VAT? So I assume, are these goods I'm not sure from the question where these goods are starting. Maybe perhaps they're going EU, NI, GB. So in that instance, is it correct, Philip, that somebody must register for VAT in the UK and charge UK VAT?
Yes, that's right. That's because they are effectively acting as the importer, and the goods are moving from Northern Ireland to Great Britain. They're imported from Northern Ireland to Great Britain, so they would need to be registered, VAT registered in the UK in order to act in that capacity. And
would they be able to claim postponed VAT accounting then on that import?
No, so postponed VAT accounting is only available for movements from outside the sort of from outside the UK into Great Britain, but because they would be accounting for it on their VAT return, the sort of overall effect is the same, if that makes sense, in terms of the sort of the timings of when they would need to report that. But it wouldn't technically be postponed VAT accounting, if that makes sense.
No, that makes sense. There's a shipping question in here. It's a company sells to non-business customers in the UK, NI, and EU. And so I think this is a question probably for Will. The goods are typically sold for less than £50, but are directly shipped to customers from China. Is VAT registration required in the UK and in the EU state? So this is where a company sells across the UK, NI, and EU.
Yep. So these goods start at the point of sale. These goods are in China. Is that right? And then they are shipped to
yeah, the UK, NI, and EU.
Yep. So if they're shipped to Northern Ireland or Great Britain and they're valued at £50, then yes, the seller would have to register for VAT in the UK and charge VAT at the point of sale, and then they'd then just account for the VAT on their UK VAT return.
Okay. So there's a lot of questions coming in here when we're using ROI, GB, NI, and vice versa. So there's another question. If an ROI company sends goods to GB via NI, so Philip, I think this is one for you, then the Irish businesses needs to UK VAT register and charge UK VAT. Will the Irish supplier be required to submit an Irish export document, and will a UK import customs document be required? So now I appreciate you may not be able to answer the Irish side of that question, but will a UK import customs document be required? I know it's a customs question, so you may not be able to answer it.
Yeah, as that's a customs question, I'd probably be a little more comfortable getting our colleagues to double check that one before I provide an answer, but we'll definitely take that one away.
Okay, great. Thank you. One, just in general, does the trader support service answer back queries? I think I know the answer to this. Probably not. And if not, where can we get direct help with these if we were unsure even after reading the guidance? I think that's a really important question, because I think, and I know with our own discussions with HMRC, we've asked for as much practical and real life examples as you can in the guidance, and we understand there's restrictions on what you can and can't provide. But I know from dealing with members' queries that this is a really key area, that they really need live examples so that they can apply the theory to their own practical situation. So where can attendees get help from HMRC if they can't find the answer in the guidance?
Thank you. So yes, that's correct. TSS does not offer advice on VAT queries. However, we do advise you to go through your normal trade bodies. So CAI, for example, you can channel those queries via the Chartered Accountants of Ireland, and they can get in touch with us directly via the normal routes. In addition to that, we have the setup with the large businesses. So if you're a large business, you generally would have a point of contact within HMRC. There's also the helplines that are available, the operational excellence teams that are available to answer any queries if you just call up the HMRC helpline. So there are a number of methods for you to get in touch with us, and we'll be available to answer those queries. Thank you.
Okay, thank you, Martin. Okay, I think we've just time for a couple of last questions. There's one here, and I think I've seen it come in a couple of times. Philip, I think again it's for you. So if there's delivery of goods from Vietnam into Northern Ireland, but the invoice, and this one comes up a lot, if the invoice is then issued by a company based in the EU, so Germany in this instance, is that included in EU acquisitions? So the fact that the goods are acquired from Vietnam into NI, but the invoice is raised by an EU country, a company based in another EU country, is that required to be reported?
I think I might hand over to my colleague Daniel on that one, if he's able to pick that one up.
Yeah, sure, Phil. So if goods, with all things on VAT on goods, it's always a case of looking to the movement of the goods, not to the company that issues the invoice. So if the goods are going from Vietnam to Northern Ireland, they are treated as a rest of the world import when they arrive in Northern Ireland, and they do not need to be accounted for on EC sales lists because they are not an intra-EU movement of goods.
Okay, thank you, Daniel. There's one query that I just got myself actually just sent in there. It's in terms of HMRC's approach, because obviously we've gone through the rules, and there's quite a level of complexity in adjusting to the new rules for businesses. In terms of HMRC's approach to compliance and perhaps where errors are made, is anyone on the team maybe able to comment and give our viewers some insight as to how errors will be approached? Is there any form of soft landing planned? Because obviously the first batch of VAT returns, I understand, have just been filed. So is there anything really that you can offer our viewers in terms of insights into what approach will be if there are mistakes made?
Yes, thank you. So we recognise that errors can occur even when a business has taken reasonable care to meet their obligations, particularly if they are faced with new, complex and uncertain situations. So if a business has taken reasonable care, there will be no penalty, and where there has been a failure in determining whether there is a reasonable excuse, we will take full account of all relevant circumstances, including how a particular business is affected, any exceptional pressure they may have faced, and how they are able to respond. So to make it very clear, HMRC is taking very much a bigger picture approach to all of this, and looking at each case in turn. Thank you.
Okay, thank you. I think we're just a couple of minutes left, so I think we might just wrap it up there. I think we've gotten through most of the questions. I just want to thank the HMRC team, Philip, Will, and Heather in particular, for their contributions to the presentation. As I said, again, the slides will be made available, as will the recording. They'll be sent around to attendees. I want to thank you for attending, and I want to wish you all the best for the rest of your afternoon. Take care, everyone.